What if you knew the exact date your dividends would cover all your bills? That's what Retire Early with Dividends.com was built for. Screen over 400 stocks, sync your brokerage with one click, and track your dividend income in real time. Our FIRE calculator maps out your path to financial freedom. It's free to start, no credit card required. Visit Retire Early with Dividends.com today. Hey guys, how's it going? Welcome back to Retire on Dividends. Jordy here, and today I want to get real with you about a pretty big move I made in my portfolio recently. If you've been following along for a while, you know I've held YieldMax ETFs, funds like CONY, TSLY for quite some time now. And look, I've talked about these in previous episodes. I've gone back and forth on them. I've shared how I was using them wrong, how I shifted to treating them as tactical positions. But recently, I finally pulled the trigger and sold most of those positions entirely. And today, I want to walk you through exactly why I did it, where that money went, and what I learned from the whole experience. So, let me start with what actually pushed me over the edge. If you've been holding any of these Yield Max funds, you've probably noticed something that's been bugging you in the back of your mind. The share price just keeps going down. And I don't mean like a normal market pullback where it dips and recovers. I mean a slow, steady decline that happens month after month, even when the underlying stocks are doing fine or even going up. That's NAV erosion, and it's the elephant in the room with these products now. I've talked about NAV erosion before. Back in episode 8, I went pretty deep on MSTY and how distributions were essentially coming from your own principal. I compared it to taking money out of your left pocket and putting it in your right pocket. And intellectually, I understood that concept. But there's a difference between understanding something intellectually and actually watching it play out in your own portfolio over 12, 18 months. That's when it really hits home. Let me walk you through some real numbers here because I think this is the part that's going to resonate with a lot of you. Let's take TSLY as an example. That's the YieldMax Tesla Option Income ETF. Over the past year, TSLY paid out about $30.95 per share in distributions. Sounds amazing, right? But here's the thing. The share price dropped about 43.8% over that same period, Shay. So if you bought in and you were collecting those Jew every month, feeling great about your income, meanwhile, your actual investment was getting cut nearly in half, the total return with distributions included was only about 11%. And that's not terrible, but Tesla itself, ticker TSLA, had a phenomenal stock, went from the low 200s up to over $400. You would have been way better off just owning the stock. And it's the same story across a lot of these funds. Let me give you another one. APLI, that's the YieldMax Apple Option Income ETF. Over the past year, the share price dropped about 28%, while Apple, ticker AAPL, the actual stock, was trading around $256 and doing just fine. The total return on APLY was basically flat, negative 0.2%. You collected all those distributions and ended up right where you started, or maybe even slightly behind after taxes. That's not building wealth. That's running in place. And then there's the one that really shocked me, AIIYY, the YieldMax C3.ai Option Income ETF. This one had a price decline of 81%. Even after all the distributions, the total return was negative 48.7%. That's not income investing. I don't even know what to call that. That's just losing money with extra steps. Now, look, I'm not here to bash YieldMax. I want to be clear about that. These products are designed to do what they do. They use option strategies to generate high current income. And for certain investors in certain situations, they can serve a purpose. Some people are using them tactically and doing just fine. The CHPY fund, for example, the YieldMax Semiconductor Portfolio Option Income ETF, actually had a total return of about 74.9% over the past year. So it's not like every single fund is a disaster. It really underlying asset and the market conditions. But here's what I realize about my own situation. I was holding these things as if they were long-term income positions, and that's just not what they're built for. When I looked at the distributions I was getting and I saw that 88, 90, sometimes 98% of those distributions were classified as return of capital, that was the wake-up call. Return of capital means they're literally giving you your own money back. It's not income generated by the fund strategy. It's your principal being handed back to you in smaller pieces while the share price shrinks to reflect it. And the tax situation made it even worse. I talked about this with MSTY before, but it applies across the board. When you think you're getting return of capital and expect favorable tax treatment, but then tax season around and some of these distributions get reclassified, it creates this whole mess. Some funds had 0% return of capital in their distributions, meaning 100% was taxable income. Others were almost entirely return of capital. It's inconsistent, it's hard to plan around, and for someone trying to build a reliable retirement income stream, that unpredictability was a deal breaker for me. So I made the call. I sold out of most of my YieldMax positions, CONY, the TSLY, the YMAX fund of funds. I trimmed them all way down. I kept a tiny position in CHPY, just about 2.25 shares, basically a tracking position so I can keep an eye on how the semiconductor focused version performs going forward. But the bulk of that capital, I moved it into something I'm a lot more excited about, and that's BTCI, the NEOS Bitcoin High Income ETF, ticker BTCI. Now, if you caught episode 1 where I talked about CONY and being bullish on Bitcoin, or episode 3 where I dove into Bitcoin's role in a dividend portfolio, you know I've been interested in generating income from Bitcoin exposure for a while. BTCI is where I landed, and I want to explain why I think it's a better fit for what I'm trying to do. BTCI, Bitcoin to generate income, similar in concept to what YieldMax does with individual stocks. But there's some key differences that made me a lot more comfortable. First, Bitcoin's volatility actually works in your favor with an options income strategy. Higher volatility means fatter option premiums, which means more income potential. And unlike a single stock that can have company-specific risk, like a bad earnings report or a CEO scandal, Bitcoin's volatility is more tied to macro factors and adoption cycles. It's a different kind of risk. One I'm personally more comfortable with because I'm long-term bullish on where Bitcoin is headed. Let me tell you where I am with this position right now. I've got about 3,433 shares of BTCI at an average cost of about $52.06 per share. The current price is around $34.57. So, yeah, I'm underwater on the cost basis. I'll be honest about that. But here's the thing. The annual income from this position is projected at about $53,288. And I've already collected over 10,400 in distributions since I started building this position. That's real income hitting my account. Now, you might be thinking, Jordy, wait a minute. You just said the share price is below your cost basis. Isn't that the same NAV erosion problem you had with YieldMax? And that's a fair question. Here's why I see it differently. Part of that price decline is tied to Bitcoin's price movement itself. Bitcoin has pulled back from its highs, and any Bitcoin linked fund is going to reflect that. But the key difference is that when Bitcoin recovers, and I believe it will because of the fundamental supply dynamics and institutional adoption we're seeing, BTCI should participate in that recovery in a way that YieldMax single stock funds often don't because of how aggressively they cap the upside. The other thing I like about BTC is the diversification of the income strategy. It's not just a simple covered call on one asset. NEOS uses a more sophisticated approach that aims to balance income generation with NAV preservation. Now, no fund is perfect, and I'm not going to sit here and tell you there's zero risk of NAV erosion with BTCIs. That would be dishonest. But from what I've observed so far, The decay is much more manageable compared to what I was experiencing with the YieldMax lineup. And here's the math that really sold me on the switch. With my YieldMax positions, I was watching my principal shrink by 20, 30, 40% while collecting distributions that were largely just my own money coming back to me. With BTCI, even if the share price fluctuates with Bitcoin, I'm collecting income from option premiums that are genuinely generated by the strategy, not just carved out of my principal. And if Bitcoin goes on another bull run, which I think is a matter of when, not if, the underlying value of the fund should benefit significantly. I also want to mention that I didn't put everything into BTCI. I'm not that crazy. A chunk of the proceeds from selling the yield max positions went into my core holdings. SCHD is still my largest position at about 12,600 shares worth around $395,000. That position alone is generating over 13,000 a year in dividend income, and it's growing that dividend. That's the foundation. That's what I sleep well at night knowing I own. I also added to VOO, the Vanguard S&P 500 ETF, where I've got about 405 shares worth around 253,000. And VTI, Vanguard Total Stock Market, where I'm at about 390 shares worth around 131,000. These are the boring, reliable wealth building engines of the portfolio. They don't generate flashy yields, but they grow consistently over time. And when I eventually need income from them, I can either sell shares or shift into higher yielding funds at that point. Between all my positions right now, the total portfolio is sitting at about $1.33 million, and the annual dividend income across everything is just over $99,000. That's a number I'm really proud of. And honestly, a lot of that growth came from redirecting those YieldMax distributions into better long-term holdings over the past year, before I finally sold the positions entirely. One thing that really helped me see the full picture was tracking everything on Retire Early with dividends.com. I know I've mentioned it before, but this is genuinely how I figured out that my YieldMax positions were underperforming. When you can see your yield on cost, your total dividends received, your current value, and your price change all in one place, it becomes really obvious which positions are working for you and which ones are slowly bleeding out. Like I could see that my SCHD position had a cost basis of about $25.24, and the current price is $31.61. That's capital appreciation plus growing dividends. Compare that to a YieldMax fund where the cost basis is above the current price and the dividends are shrinking. So the portfolio tracker makes it impossible to lie to yourself about what's actually happening. If you're sitting on YieldMax positions right now and you're not sure whether to hold or sell, my suggestion is to do exactly what I did. Pull up your actual numbers, not the advertised yield, not the monthly distribution announcement that looks exciting. Look at your total return. Look at what you put in, what you've gotten back, and what your position is worth today. If the total return is negative or barely positive after a year, and the underlying stock has done telling you something important. And look, I want to be really clear. This is not financial advice. This is just what I did and why I did it. Your situation might be completely different. Maybe you're in retirement right now and you need that high current income and you're okay with the NAV erosion because you're spending the distributions anyway. Maybe you're using these tactically for short periods during volatile markets and taking profits. There are legitimate use cases. I'm just saying that for my personal goal of building a portfolio that generates sustainable, growing income for decades, YieldMax wasn't the right tool for the job. BTCI combined with my core holdings of SCHD, VOO, VTI, JEPQ, and JEPI, that feels a lot more solid to me. Speaking of JEPQ and JEPI, those are still meaningful positions for me. JEPQ is sitting at about 2020 shares worth around 116,000, generating about 12,400 a year in income. JEPI is at about 1,934 shares worth around 114,700, throwing off about 9,160 in annual income. These are covered call ETFs, too, but they're diversified across dozens or hundreds of holdings. The yields are more sustainable, and the NAV erosion is much more controlled compared to single stock yield max funds. They're not perfect, but they're a totally different animal. I also want to quickly mention I picked up a position in what used to be called MicroStrategy, now known as Strategy Incorporated, ticker STRC. I've got about 521 shares at a cost basis of roughly 95.93 with the current price around 99.80. That position is generating about $5,863 a year in income. This gives me direct exposure to a company that's essentially a leverage Bitcoin play, but with an income component. It's a newer position, so I'm still watching how it develops, but I like having multiple angles on the Bitcoin thesis. So to bring this all together, here's what I've learned from my YieldMax experience. One, headline yields can be incredibly misleading. 100% yield means nothing if your principal is declining by 50%. Two, return of capital and distributions is not income. It's your own money coming back to you while your investment shrinks. Three, single stock covered call ETFs have a structural problem where they cap your upside but give you full downside exposure. That asymmetry works against you over time. Four, there are better options out there for generating income from high volatility assets. BTCI is one I'm personally using, but do your own research and find what works for your situation. And five, tracking your actual numbers, not projected yields, but real total returns, is the only way to know if a position is truly working for you. Retire early with dividends.com makes that really easy if you wanted to check it out. The portfolio is in a much better place now, almost $100,000 a year in projected dividend income, a solid core of growth and dividend holdings, meaningful Bitcoin exposure through multiple vehicles, and a lot less stress about watching NAV erode month after month. That feels good. All right, guys, that's what I've got for today. I hope this was helpful, especially if you're wrestling same decision I was about whether to hold or sell your yield max positions. Again, not financial advice, just sharing my journey and the reasoning behind my moves. If you're not subscribed yet, hit that subscribe button. And if you found value in this, share it with someone who might be staring at their yield max positions, wondering what to do. We'll see you in the next one. Take care.